Hello everyone. Today we are going to go over one of the most basics forex strategies called Trendline strategy, and it's basic since it has three key rules that are very easy to set and to identify, and therefore it offers you a very good risk to reward ratio, which is of course key in every trade. So first, we mentioned three basic rules. So the first rule would be to identify swing highs or lows, depending is it a bearish or a bullish trend line strategy. We have two examples here in two major pairs, euro dollar and dollar yen, to show how this strategy actually works in practice. So here we have a euro dollar. Here we are clearly in the downtrend because we are creating lower highs and lower lows, and therefore we are trying to identify peaks. So here is a first will be a first peak, and then as the price goes down, then we are looking for a second peak that we can connect with trend line. And what's important here, that between these two touches 1 and 2 we don't have any break of the trend line. So the trend line needs to have at least two, of course, touches that we can connect, and then as soon as the third touch happens, we are actually looking to enter into the trade. So the third touch should be the first opportunity to enter into the trade and play the trade against the trend line. So here we are looking, of course, to sell the pair against the trend line, since it is very easy to identify where your stop loss is and where your take profit is, as we're going to see now in this euro dollar chart example. So here we have two touches, as we said, and then we're looking for a third touch to enter into the trade. As soon as the third touch happens, here we can see it happened in this particular case at 121.40. We are selling the price, so we are entering a trade at market at 121.40, and our stop loss should be approximately in this strategy around 10 to 15 pips above the trend line. Here we are talking about a 1 hour chart, and this strategy works best on 1 hour chart. So here we sell the pair at 21.40, but actually why I choose this example is because here we also have 100 MA, which is also which will also provide a very solid resistance to any move that has tendency to go higher. So what is actually advisable here is that you use both these lines as resistance. So you will sell at the trend line at 121.40, but you will put your stop loss actually above the MA 100. Why? Because the price may move briefly above the trend line and then react and turn lower after touching the MA 100. So here you would put your stop loss approximately 4 or 5 pips above moving average, and you can see here that what happens is the price touched the trend line and then returned back, of course, rotated back lower. So after you identified your stop loss, now you're trying to identify your take profit. Risk reward ratio is what you actually see here. So what are you risking in order to gain something, and it should be at least 1.5 to 1, while anything up to 2 to 1 is actually extremely profitable. So here we are risking more or less, let's say 25 pips in order to gain 75 pips. How did we identify this take profit? Well, after we identified where our stop loss is, actually we are looking to make some profit in this trade. So we're not looking to risk 25 pips to gain 25, but we're looking to gain, for example, at least 40-50 pips. And in this particular example, we have a support here, which is a horizontal support. You see that the price touched touched the trend line here and then rotated back lower, and then it bounced from this 120.60 level, which immediately becomes support. So for us, we are looking to target that support again, and this is actually what happened in the end. Of course, at this point we don't know if this is going to happen, but since we have we saw that the price has touched this 120.60, we know that there is going to be some movement and some interest in buying the euro dollar at this particular price. So the advice would be to take your profit close to this level, not exactly into a pip to this level, but actually 4 or 5 pips. And if you did this in this particular trade, you would risk, as I said, around 25 pips, and your gain would be around 75 pips. Another example that I wanted to show you is a bit different. It's dollar yen. Why it's different? Because it has many touches. It has many touches, and the second rule of this strategy is that the more touches on the trend line, the better. So it's much better if you have a trend line that connects 4 or 5 touches than if you have a trend line that connects 2 touches. It gives more validation to this strategy. So here you can see we start from here because it's a low and it's a touch number 1, and then we have a couple of touches here. Here you can see 4 or 5 touches very quickly to the trend line, but the trend line is still not broken. It's important to say that we consider that the trend line is broken only when we have a clear close above, or in this particular case below, the trend line. Only in that case we can see the trend line has been broken. So here we see multiple touches, and as I said, as of touch number 3 you can actually start thinking about entering into the trade. Intentionally I put a touch number 5 here, because as I said, the more touches you have, the better. So if you analyze this price movement, you saw 4 touches, you say, okay, I'm not going to miss another test of this important multi-week trend line, and you will enter into the trade here. So you enter, let's say, around 108.70. And then you let, as we said, ideally, since we don't have anything below the trend line, any kind of support below the trend line, then we are giving around 10 to 15 pips of a cushion in order to defend against this false breakdown that actually happened here. So this is why this example is extremely valuable to us, because it shows us that we broke below the trend line. So the price traded below the trend line, but since we did not close, you see where the close is, we actually created a false breakdown, and then the price rebounded sharply higher. So here we are buying at 108.70. We give, as I said, you can give, depending on your risk management, I will advise 10 to 15 pips of stop loss. Here I put 13 pips stop loss, and then your take profit will be the first resistance that you identified in this particular example. We see here 2 touches at this 108.93, which was horizontal support, and now it's horizontal resistance. So here we are looking to, in this particular example, we are risking 13 pips in order to gain 22 pips, which is around 1.7 to 1 or 1.8 to 1. Of course, we did not know that the price is going to go all over to 200 MA. If you wanted to be more aggressive, of course you could target this area here. But as I said, if you want to really keep it simple, just target the first resistance in this, or support that comes next. So let's just do a quick recap. 3 quick rules are: identify the swing lows or swing highs. In this example is swing lows. Second rule is that you need to connect all the swing lows and swing highs, and the more touches the better. So in this case it's fifth touch that we are trading, and in the euro dollar example is the third touch. And the third rule or step is you need to buy against the trend line if it's a bullish trend line, or you need to sell against the trend line if it's a bearish trend line. It's a great strategy, since, as I said, it offers a clear area or risk where you're out of the trade, and you don't have to really over analyze the chart to see where are you wrong, because if the price moves, if the price trades 20-30 pips below the trend line, then obviously you're wrong. And it's again, it depends on you, how aggressive are you in your trading, but it also can provide you a very good risk and reward. I hope I was very clear. Thank you very much and have a nice day.